Hi, my name is Mehmet Altın, and I would like to welcome you to a series of videos I developed as part of my revenue management class. Since I wanted to follow a well-designed book, I chose Revenue Management for the Hospitality Industry by Hayes. It's going to be second edition for these chapters. It is assumed that you have some basic knowledge of the hospitality industry before you read the book and watch the videos. Let me begin with some historical background. Revenue management, which was initially called yield management, began in the airline industry. I want you to take a moment to imagine a flight where half the seats were sold just before the departure. Do you have any plans for the ones that did not sell? Is it possible to store unsold seats for the future use? Can you just take those unsold seats, put them in the storage so you can sell it later? Of course not. The potential revenues from those seats are gone. For this reason, the idea was to sell as many seats as possible to generate as much revenue as possible. Among the first approaches to this problem came from British Overseas Airways in the early 70s. They referred that as an early bird discount. The strategy was offering discounts at certain times so they can eliminate those empty seats, that's stimulating demand for earlier flights in the process. It was later American Airlines advanced this idea by focusing on how to maximize revenue. The field of revenue management later expanded into many industries. Of course, most well known is the lodging, hotel industry. The bottom line is that revenue management can increase your revenue and profit without requiring any major capital investments. Before I start the topic, I want to talk about a little bit about the revenue management itself for your future. Is it possible that you are not considering becoming a revenue manager? That's most likely, right? Because not everybody wants to be a revenue manager. But is revenue management something you should be concerned about? Hopefully, you will have some answers after you finish this course. But in short, yes. If you want to be successful managers or owners, you need to understand basics of revenue management. If you are a hospitality student or a professional, you've seen or heard that revenue management enhances the profitability of firms and increases the wealth of owners through revenue enhancement. The goal of effective revenue management is to charge the right price to the right customer for the right product throughout the right channel at the right time. Most students, even some professionals, think revenue management is all about complicated calculations involving advanced math and statistics. It goes that, without saying that, advanced revenue management involves many complicated calculations and statistical analysis. This course is also intended to provide an introduction to basic mathematics and basic problem solving. However, the purpose of this class is not to introduce you to advanced math or statistics, but to help you improve your understanding of revenue management and be better, more desirable, and successful managers. The first thing we need to do is define what revenue is. Revenue is the total amount of sales achieved in a given period of time. Therefore, revenue is calculated by multiplying the number of units sold by the unit price. For example, if you sell 200 burgers for $10 each today, your revenue from burger today is 200 times $10 sales price equal $2,000, right? We will cover many different concepts in future videos that will help you manage revenue effectively. I would like to start by asking a simple question. Does a revenue manager's sole responsibility be to increase revenue? In the earlier example, the burgers were $10 each. Like, there is a demand for 200 burgers. because of the price. Let's say that the price is lowered to $7. As a result, we can now sell 400 burgers. The demand doubled and the revenue increased from $2,000 to $2,800. If you said that the revenue manager's sole responsibility is to increase revenue, as you can see from the results, we are successful. However, let's dig a little deeper. Suppose the burger costs $5 to make, and our burgers need to be cooked by someone who makes $100 a day. In addition, our server earns $100 a day. Once again, my numbers are inflated, but bear with me. Due to increased demand, we need to hire additional cook and server. Let's do some more calculations. Let's look at the first one. Assuming all other costs remain the same, the first scenario will result in a profit of $800. Even with the increased demand, scenario 2 yielded $400 profit. We made $2,000 in the first one and $2,800 in the second one. So demand and revenue increased in both. The reality is that we are making less money. Many other issues related to increased demand are not even considered in these calculations. I know it's an exaggerated example, but as you can see, we lost profit while increasing revenue, which you agreed was our revenue manager's job. Money that goes to owner's pocket is gone. This simple practice is intended to highlight that you have to consider many other factors to become a successful hospitality professionals, managers, or business owners. As we have seen in our example, revenue optimization is more important than revenue increasing strategies. Our focus overall will be on consumer-centric approach. We will discuss more about that later. Here are some things revenue manager should do to be an effective revenue manager. The first thing you need to know is how important revenue management is. As pricing and techniques have advanced, revenue management strategies have added billions of dollars to many companies' bottom lines without requiring major capital expenditure. This is important. Of course, you have to have some kind of expenditure. You have to hire a manager, maybe you have to implement a computer system, but without requiring major capital expenditure, you are making $1 billion is extremely important. In the absence of revenue management strategies, those revenues will not be generated. Second, many factors, including human nature, economics, psychology, etc., should be taken into account when considering revenue management decisions. You will gain a better understanding of those factors through this course. Last but not least, it goes without saying that businesses are always competing with each other. And you need to learn to make better decisions if you want to succeed. It is crucial for us to understand how revenue generation works so that we can be successful. Specifically, determining the price that customers are willing to pay. To accomplish this, let's discuss what business is all about. It is likely that you will get two related answers when asking hospitality professionals about the purpose of their business. To achieve profit is one of the goals. The second goal is to generate a return on the owner's investment. One thing I would like to clarify is that we need to generate profits and make money for the owners. Unless you do this, your business will fail and you will lose your job. We must understand the keyword primary focus, which means focusing on profit or return on investment over some other areas, in our case is the customers. Let us discuss the flaws of these approaches before we discuss the other areas that needs to be addressed. Taking the accounting approach, profit is determined by subtracting total operating costs from revenue or sales. Whenever we talk about cost, we mean all kind of costs, right? Such as fixed costs, variable costs, controllable costs, uncontrollable costs. In the same way, income and sales can be substituted for revenue. In this sense, we can simply simplify this formula. Profit equals revenue, or sales minus cost or expenses. It is important to focus on different definition of profit from simple accounting perspective. The information age provides customers with many choices. Therefore, successful revenue managers must understand that customers, as well as their businesses, are seeking profit. We are going to more focus on that. But as far as the customer is concerned, they should also perceive value in the transaction. I am going to use this concept in many times. They need to perceive a value in the transaction. This will be explained in more detail in the next slide. Let's try to understand the barter. What's the barter is? Barter is an effective way to exchange goods and services. In this type of economic exchange system, there are no buyers or sellers, and no accounting term for profit is used. Let's say you make bread every day, but you don't want to eat bread every day. There is a poultry farmers raising chickens in your area. Two of you sat down and agreed to exchange 2 loaves of bread for 1 chicken. The poultry farmers now has 2 loaves of bread, and the bread maker now has a chicken. This kind of transaction involves both sides giving up something and gaining something at the same time. There must be a value in exchange for both sides. Otherwise, bartering wouldn't take place. In this case, we assume both parties are happy and that the transaction meets their needs, right? They are both happy and the transaction exchange between the bread and chicken meets their needs. Of course, bartering is not without its problems. As a bread maker, you have to find poultry farmer that is looking for bread and willing to give up chicken in order to make a transaction. When you consider how many transactions each of us makes every day, you can see how helpful money is. To measure the value of goods and services, money is an acceptable medium of exchange. Consider the case where the seller sells a chicken for $10 and I can afford to pay with my hard-earned income. As a buyer, I am willing to pay $10 for a chicken in this more efficient trading system compared to barter, of course. Likewise, the seller has many associated costs to bring the chicken to market and is willing to sell it for $10. Now, the chicken was valued at $10 by both of us, seller and buyer. And we accepted that this transaction benefited us both. However, some other people might have a differing views on the price of this chicken. You might say that chicken is only worth, let's say, $8. Perhaps you are a vegetarian and you will not agree to the transaction at all, right? There are some important lessons we can learn from this example. First of all, how does chicken get its value? According to our discussion earlier, they could use an accounting approach to determine value, in which they add profit to their cost, or they could use some historical value of the chicken to determine value. Imagine how you will price a hospitality product. There can be a wide range of values for your service depending on who you are serving. The time of the day, for example, lunch versus dinner. Type of property, fast food versus luxury diner. The location, suburban versus airport, etc. It is possible to provide many other variations. An important concept is understanding the variance in buyers' willingness to pay for goods and services with their hard-earned money. There must be a value for both sides in the transaction, And that is the most important factor. In light of the profit fallacy discussed earlier, we assert that many external and non-cost related factors influence buyer's decision, like, for example, vegetarian example, right? That we should be aware of to be effective managers. Basically, we need to know, we need to understand our guests, our customers. With our previous explanation in mind, hopefully we now understand that maximizing revenue and profit should not be the primary objective of the business, but ensuring customers also gain value from the transaction. A similar to profit approach, many in the hospitality industry believe management's primary responsibility should be to increase the return on investment for business owners. In economics, profit is closely related to risk. A business owner who invests his or her money in a business, such as opening a hotel, is taking a risk, which could result in loss of capital. Return on investment refers to the expected profit from the transaction as a reward for the risk you take. So basically, you are investing something, you want profit. That's what your risk is about. You want to make money. Your finance and accounting classes use the term ROI, or return on investment, which is calculated by dividing investment return by original investment. Let's give an example. Imagine that you invested $800,000 and you received $200,000 in return. We can calculate the owner's return on investment by 200,000 divided by 800,000, 0.25, which is 25%. Profits and return on investments are valid goals, but why should customers care if you make a profit or return on investment? Like, for example, yourself. Do you consider if a hotel is making enough money when you see their prices, offers, and packages as a customer? So that's the point of all this exercises so far. Please understand that we have to generate income and profit for our owners. I am not saying to ignore profit, cost, return on investment, etc. However, in the long run, however, what you focus on will determine the success of your business. In the short term, you may be successful if your primary focus is earning money, but in the long term, your businesses may struggle. Based on all of these examples and discussion, we can conclude that the purpose of business is to create and keep customers. The reason we spend all this time on this topic is that you need to have a mindset that says, my main focus should be on my customers. In order to attract customers, you must provide value in your offers, pricing. If they do not perceive your offering as valuable, they will choose your competitors. Thousands of articles and research shows that hospitality businesses become successful when they focus on customers. Based on all these discussions, we can conclude that revenue managers and successful businesses strive to provide value to customers and make sure that company's price matches the customer's willingness to pay. I want to repeat that again. Sorry. Company's price matches the customer's willingness to pay. Profits and return on investments are not ignored, but businesses that serve their customer needs effectively will be successful and generate more profits than those that do not. These approaches should be customer needs driven and place long-term customer gain ahead of short-term revenue maximization. These are the two major points. Now, this is one of the definition of revenue management, right? The right product is determined by both customers and the hoteliers. It is the product that delivers value to the right customers by satisfying their needs, wants, requirements, and also reflects the customer's willingness to pay and is profitable for the hotelier, for the hotel owners. Not all customers are equally profitable for the hotel. Different segments create different value. Let's not forget that. We're going to focus in the future chapters. Timing is one of the most significant concepts in revenue management. One and the same offer could be perceived differently only on the basis of when it has been made, right? Like for example, like pre-Christmas Day promotion offered in July will most probably remain unnoticed because it's published too early. The right price is the price that the customer is willing to pay and the hotel is willing to charge. And also each distribution channels, we are going to talk about those as well. There are different distribution channels that you can sell it yourself, you can use OTAs and etc. Each distribution channel provides access to different customers and requires different costs to sustain. Like if you are getting from OTA, you have to pay them. Once again, like I said, we are going to discuss more and more on these topics. Now, I want to give general what is this book's and chapters about. Chapter 1 presents an overview of the text and introduction of some key terms. You need to read that, and there will be another video after this. I'm going to give you some basic calculations also. In Chapter 2, you will learn about the important role that thoughtful pricing plays in business, as well as the serious limitation of utilizing either a supply and demand based or cost based rather than customer value based approach to pricing. In Chapter 3, you will learn that individual consumers' own perception of the value and worth of a product is the primary reason they are willing to buy it. In Chapter 4, now we are getting more into revenue management mathematical approach in a sense, that we are going to learn how consumers' differing perception of value lead logically to the practice of charging different prices to different customers. And Chapter 5, we will learn to answer the question, why is specialized knowledge required to effectively price and manage the sale of products and services in the hospitality industry? I mean, the answer to that question is, of course, constrained supply, the condition that exists when sellers cannot readily increase the number of products or services available for sale, like when consumer demand. Like you have an hotel, 100 rooms, now there is a 400 people wants to room, you cannot just add rooms. But like I said, we are going to discuss more on that. Next one is Chapter 6, and we will learn why it is so important for revenue managers working in the lodging industry to create accurate estimate of the guest demand, which is going to focus on the forecasting. In Chapter 7, we will learn how lodging industry revenue managers monitor the number of rooms available for sale and the prices to be charged for them. In Chapter 8, we will learn how revenue managers administer various sources of room reservations. These sources are called channels and come in two major forms. It could be electronic or non-electronic. We're going to talk about them. In Chapter 9 is we will going to focus on, we have to understand that revenue managers in today's hospitality environment most often find themselves watching valuable data, information, right? As well as an overwhelming amount of new data management tools and service providers. So data analysis is starting to affect more and more our industry. We are going to learn a little bit about that. And also I just developed business analytics, hospitality intelligence analytic course, focusing on more aspect of this part in the business analytics. And Chapter 10, we will learn on how a hotel revenue manager's performance can be assessed using the following key performance indicators. Now, these are some of the basic things we are going to focus, especially in the first chapter. ADR is the average or mean selling price of guest rooms during a specific time period, such as a day, week, month, or year. Average daily rate we use. Occupancy percentage is the number of rooms sold during a specific time period, expressed as a percentage of all rooms available to sell during that same period. RevPAR is the short for revenue per available room. It is the average revenue generated by each available guest room during a specific time period. Let's not forget per available room. We are going to discuss in the future about that. Available room versus how many room could be different. And RevPOR, revenue per occupied room, is a performance metric that calculates a hotel's Hotel's total revenue divided by occupied rooms for a given time period. GopPAR is the short for gross operating profit per available room. This is also average gross operating profit generated by each available guest room during a specific period of time, also written as a GopPAR. Gross operating profit is equal to net revenues minus cost for serving customers, the cost of goods sold, marketing, etc. And of course, total revenue, we already talked about that. When we say total revenue, we are talking about, especially in the RevPOR, accommodation, right? That's the major things in the hotels, but there could be also other things like breakfast, bar, minibar, etc. Any other extra revenues. That's beyond the room revenue, basically. In chapter 11, we will focus on that factors that must be considered prior to establishing menu prices. Like we are going to focus on in the both chapter 11 and 12, chapter 11 and 12 in the food and beverage sector. We need as in food and beverage professionals, we need to monitor and evaluate the revenue generating characteristics of our operations. And RevPASH is short for revenue per available seat hour. It is the revenue generated during a specified time period divided by the number of seat hours available during that period. Now, don't forget to watch chapter 1, apply what you know video for some problem solving and analytical works. Thank you.